Gary, is there anything you want to say before we get into this next section on income tax deferral for selling appreciated assets?
Well, the point I raised way back in the beginning, all of the legislative proposals deal only with grantor trusts. And so if you have clients who did not do their pre-enactment planning, the law comes in, you can't use grantor trusts anymore for estate planning. Does that mean that everything is gone? And the answer is no. You can still use non-grantor trusts. The problem is, in order for the trust to not be a grantor trust, it cannot be for the benefit of your spouse. It can only be for the benefit of your descendants. So that's a limitation. But a lot of the estate planning techniques that we have used in the past with grantor trusts can be readily adapted for non-grantor trusts as well. For example, let me give you a simple example. An individual has $10 million of cash and he has an opportunity to invest that $10 million in a real estate venture that they know is going to make a lot of money. So what the individual does is they lend the $10 million on a 20-year interest-only promissory note to the trust. The interest rate that can be charged is as little as 2%. So what that means, the individual lends $10 million to the trust, takes back a $10 million interest-only promissory note at 2% with all principal due in 20 years. Because it's a complex non-grantor trust, $200,000 of interest income and $200,000 of interest expenses are reported each year. The trust then takes the $10 million and uses it for a acquisition of debt finance real estate. And if the debt finance real estate after the payment of the mortgage exceeds 2%, the non-grantor trust keeps the spread, and more importantly, if the real estate appreciates in value, it's all with the trust. So there are plenty of transactions that are still available if the law changes and you haven't done your planning before. And what the slides are designed to do is show all the little things. I'm assuming this is done after the effective date. Want me to go on or what?
Yeah. Please do. I think this is mostly the tax professionals who are left here.
Okay. Now we got 309 people left.
Well, a lot of them fell asleep.
Okay. All right. So under the proposed legislation, two things. Number one, any grantor or trust created after the effective date, even though it's an irrevocable trust, will be included in the grantor's gross estate when they die. So effectively, nobody's going to start creating grantor trusts after the effective date. But here's something interesting. Remember, the technique we used to use was an installment sale to a grantor trust because there was no income tax sale. So Code Section 1062 basically says, if you sell an appreciated asset to a grantor trust, you're going to have to treat that as an income tax realization event and report the gain for income tax purposes, but you can defer the reporting of the gain under the installment method. So all installment sales to grantor trusts that relied on the fact there was no sale, so no gain had to be reported, will now be income tax recognition events. So what? We can still use this for income tax advantages. And the rest of the slides kind of have a number of examples. Okay.
You want to go through one of the examples?
Yeah. Okay. Now, remember that Congress said we're going to eliminate valuation discounts for marketable securities. But you can still take valuation discounts for your closely held business. So let's suppose that senior happens to own a family business worth 30 million with an income tax cost of 20 million. So it's an operating business. So if senior wanted to do estate planning with that, they could reasonably discount it for lack of control and lack of marketability to $20 million. Okay? So let's suppose that senior values the business at $20 million with an income tax basis of 20 million. So what does the next slide show you? Okay. He sells the business to the non-grantor trust for an interest-only $20 million installment note. Well, guess what? Basis of 20 million, note of 20 million, there's no gain. So no gain is realized, and so what this means is each year senior reports 400,000 of interest income, and the trust reports a $400,000 interest deduction. So from an overall family point of view, it's income tax neutral. So let's see what happens with that 30 million business that was sold to the trust. Let's assume that the trust just bought this $30 million business and it's earning 5%. Okay, so the trust has $1.5 million of gross income. It has an interest deduction of 400,000. Therefore, the trust has 1.1 million of taxable income. It's in the trust. So what senior has done for an interest payment for a 20 million note is shifted all but $400,000 of the income to the trust that keeps it. So each year, that 1.1 million of excess income is shifted to the trust without any estate and gift tax exposure. Now remember, if it was a grantor trust, senior would have had to pay all the income on 1.5 million. So we haven't increased the income tax burden at all. So what happens is, if this was a sale to a grantor trust, senior would have reported $1.5 million of income and paid the taxes on it. Now senior reports 400,000 of income, and the trust reports 1.1 million of income. So the income tax costs overall haven't changed. Now, here's what's interesting is, as a grantor trust, the entire 1.5 million would have been taxable to senior at senior's very high income tax rates. Alan.
Yeah.
This is a non-grantor regular complex trust that has 1.1 million of taxable income. Taxable if the trust reports it all at the highest income tax rates. And the trust reaches the highest income tax rates at $13,000. Is there a way for this non-grantor trust to assign some of that 1.1 million to taxpayers in lower income tax brackets?
Right. All it has to do is make distributions to individuals or charities during that year or in the first few days of the following year. And that.
So in other words, Alan, is the beneficiaries of that trust are my descendants. My descendants include my adult children and my grandchildren. And what if all the grandchildren are, not earning any income or just right out of college in their first jobs? Are they in lower income tax brackets?
Absolutely.
So suppose I have grandchild that just graduated from law school and is earning only $60,000 or $80,000 a year? Does it make sense to shift income from the high bracket trust to them?
Absolutely. Jerry, how can I shift income to them without giving them the money?
Well, you create trust. You
Create a 678 trust for each of them and then give the money to the 678 trust? Is that the way to do it?
Well, I like to keep it simple and say give it to them outright. Giving it outright to your children who are responsible adults is not really a problem. But for your grandchildren, you would have to, consider maybe creating creating a grant or a trust for the benefit of the grandchildren, which is under Code Section 678. That could be a possibility, because remember, the grandchildren may never be exposed to estate taxes. So if it's a grant or trust that's to the grandchildren, who cares?
Yeah, I think the 678 trust is going to be the answer, because a lot of my clients don't have responsible children or grandchildren, or they're worried about creditor protection. They're worried about estate tax protection for the children who are already wealthy. So that'll all have to be worked out somehow.
Yeah. Or basically maybe, put the income into partnership interest where they all get our limited partnership interest, something, whatever it is, there are solutions.
So you want to go to the next slide when the company gets sold?
Yeah, and here's the estate planning benefit. Not only did you shift 1.1 million of income into the trust, but remember, the trust paid 20 million. So the business increases from 30 million to 36 million. And the income taxes, remember, the senior's basis was 20 million. And if it's sold for 36 million, there's 16 million of gain. You can't get around it. So what we have done is the estate plan, in addition to shifting 1.1 million to the trust every year, all of the discount plus the appreciation from 30 million to 36 million is also in the trust. So essentially your discount planning and your freezing at the discounted value is still available. It just changes some of the income tax ramifications of it. And then we saw the income tax changes, the total income taxes are still going to be paid the same, whether it's a grant or trust or complex trust. So it doesn't really matter. So you can still use complex trusts for estate planning as well.
Okay. And do you want to go ahead and run through the installment method of accounting discussion?
All right. Okay. So here's an interesting situation that is very common. Senior owns a 25% interest in an operating business, and the other 75% owners are unrelated third parties. And Senior has a buyout agreement. Senior is, basically saying, a few years not from now, I'm going to retire, and under the buyout agreement, the remaining partners or shareholders in the business will buy me out. So we look at this, and Senior's basis in the 25% interest is 4 million, and the buyout agreement currently values the business at 16 million. So let's suppose that Senior creates a family trust that's a complex trust for the benefit of my descendants. Since it's a non-grantor trust, that is a sale for income tax purposes. But by the way, it's an installment sale. So if the trust gives Senior a interest-only promissory note with a 20-year maturity, the gain that Senior realized by selling the business to the family trust for 16 million with a 4 million basis is $12 million. and senior can report that 12 million gain 20 years in the future when the trust, I'm sorry, when the note is paid. So if the trust later sells, senior retires, say 3 years later, and the trust gets redeemed for 18 million and paid 16 for the 25% interest, the trust basically has only a 2 million gain. So there's a small estate planning benefit. We've frozen the business at 16 million and shifted the future appreciation to the trust. But what's the income tax advantage to this? Well, wait a minute. I create a trust for the benefit of my descendants. It's my family. And I make it a non-grantor trust, and then I sell that family business interest to this trust for a 16 million note. I have a 12 million gain, and I don't have to report that gain until 20 years from now. And the trust only has to report 2 million a gain because it paid 16 million for the asset. Alan, that sounds too good to be true, doesn't it?
It does.
So
Absolutely.
Congress said, you're right, it's too good to be true. So Congress basically enacted a rule. Let's go on to the next slide.
It's the code section of the day, 453E.
And it's very simple. Congress said, that's too good to be true. So if senior sells the appreciated asset to a related party, that family trust for the benefit of my descendants, clearly a related party, and defers the reporting of that 12 million realized gain under the installment method, and the related party resells the asset it purchased from senior anytime within the next 2 years, the gain senior previously deferred under the installment method is immediately accelerated. So what is the advantage of senior retiring 2 years and 1 day later?
Deferral.
Right. The
Beautiful.
statute is basically saying what you can't do, but it's telling you that all the trust has to do is wait the 2-year holding period. And by waiting the 2-year holding period, the resale will not accelerate the gain previously deferred on the first sale under the installment method. So what that means is the trust gets 18 million of sale proceeds. Go on to the next slide. Okay, go on. All right, go on. Next one. Go on. All right. So hold on. Go on next. All right. All right. So basically, we had a small estate freeze. Oh, by the way, I didn't take any discounts. Why didn't I take any discounts? Because I wanted to maximize the income tax gain that can be deferred. So right away, one time I had one of these audited, and the estate tax examiner said, there must be something wrong. You didn't take any valuation discounts. I said, well, you don't like them. So the point is, in this situation, there's been a modest estate freeze, but more importantly, out of the 18 million of sale proceeds, the trust only has to pay taxes on a 2 million gain. And that's a 20% capital gains tax. So all of a sudden the trust is left with $17.5 million of cash that it can do whatever it wants with. So that is a very nice transaction. Whew.
Does the IRS like these or dislike them?
It doesn't matter what the IRS likes or dislikes. They're bound by the statute. And every time I've had these audited, well, the first time I had it audited, the IRS lawyer who was looking at it said, this sounds too good to be true. And then I said to her, who taught you income tax in law school? And she said, you did. So I said, didn't you remember when I taught this to you? And she said, oh yeah, it works. In other words, it's right there in the statute. And we don't take any valuation discounts because we want to maximize the income tax deferral. So it's a very nice transaction.
You know, Jerry, every once in a while, my receptionist, who's always somebody new, says, I had a call from a Professor Calfee at the University of Florida, and he said, if you don't call him back today, he's going to change your partnership tax grade. You might want to use that line.
For 20 years ago.
So, Jerry, I'm going to say that you've been involved with the two most notable tax institutes in the United States, the Heckerling Institute, which you have a beautiful video on YouTube, and the Notre Dame Institute, which you've been the director of for several years now. And what I love about the Notre Dame Institute is that you personally pick the topics and tell the speakers what to make sure they cover, to make sure that it's new areas that are different and interesting and quite candidly need to be covered. You require that the speakers prepare papers, just like in the old days when we were required to prepare papers for everywhere we spoke. And you run it in dual sessions so that every hour the participant can pick a intermediate or an advanced session. And I love the fact that it's 2 days long. That's about as long as anyone can actually handle psychologically and emotionally of learning tax and estate planning. I particularly like that my partners, Chris and Brandon, are going to be speaking on slats from 3 p.m. to 5 p.m. October 20. I like the fact that this is going to be a cyber program so that I can get live recordings and listen to them anytime I want. And in fact, I like to listen to these at 1.5 times speed. I find everybody sounds like Mickey Mouse, but it's faster and I have better attention that way. And I listen to them using the Timmy system where I can also see what they're saying. Timmy prints out the words while the person is speaking when you replay it at 1.5 times speed.
Well, here's something very interesting. First of all, what do Brandon and Chris have in common with respect to me?
Well, Chris was one of your students at
They both were.
Oh, was Brand? Oh, that's right. I didn't remember that.
They were both my former students. And most of these programs, they give the speakers 45 or 50 minutes to speak. I increased the program to 60 minutes. And I told all my speakers, the extra 10 minutes is not to add new materials. The extra 10 minutes is to start out with a review of the basics. And for the slat thing, it's 2 hours. So they're going to basically, on the slat program, really go step by step with all the basic details, because it's hard to squeeze everything in 1 hour. So I gave them 2 hours. Now here's the big advantage. It's one thing sitting for 8 hours in a live program. Notre Dame is virtual this year. It's another thing to sit in front of your computer screen for 8 hours. Oh. So what we did is, and bus I have dual sessions because you only listen at one session at once. So a lot of people said that what they liked about Notre Dame was they didn't have to sit there for 8 hours. Like one person said, I just listened to the morning sessions and did other things in the afternoon because we made the recordings for every single session available as part of your registration fee for 6 months after the Institute. So basically that meant it gives you the luxury of having the ability to listen to everything at a more leisurely pace.
Right. So I hope everybody considers signing up for this program. It's a tremendous program when you compare it to the other programs because of the depth. I mean, look, Jason Havens, I see here, is going to spend an hour on the impact of mortality tables on charitable split interest trusts. He's going to really be able to give us a deep dive and a much better understanding of
Basically,
how this trust
everybody knows what the charitable planning techniques are. Jason is going to show how you can arbitrage interest rates and the mortality tables that actually increase the income tax and state gift tax benefits of these charitable giving techniques in ways that you hadn't thought of before.
Yep. Yep. Okay, so Jerry, I really appreciate you joining us. Next time we'll make sure your camera's working.
I'll figure it out in advance.
Yep. We have a lot of questions we weren't able to answer. We will be back, or I'll be back next week. And Jerry's always welcome. If you have any questions, comments, or suggestions for us, we appreciate it. We're having a great time with this program. And thanks for listening. And we hope that you can use this knowledge to help your family and to help others. Have a fantastic day.
All right. Thank you, Alan, for inviting me. I appreciate it.
All right. My pleasure always. Take care.